Golden Investment Rule: Decoding the Principle of Successful Investment of the New Generation King Ed Seykota. Risk is the unspecified probability of a loss. If you can determine exactly what the risk is, it will no longer be a risk. Ed Seykota is known to long-term investors around the world as a new generation of talented investors with a record of generating 250,000% return in 16 years of experience. Seykota's talents can rival the previous generation superstars like Warren Buffett and George Soros. As an investor, Ed Seykota is one of the legends of the next generation. He is the representative for the trader model, equipped with both information and intellectuals, with an electronic engineer degree at MIT, and the trend-following trading methods are quite simple and easy to understand. Until now, it seems that he has always been a prominent monument in the quick trading method and considered by many traders as idols. His trading style has influenced many transactions of the younger generation on Wall Street. Besides, our masters are also people who believe in the two words principle. Everything he did was based on the strict trading discipline that Seykota himself set out for himself. That's why he kept his calm even when things didn't work out. He is also a pioneer in programming trading systems. Inspired by Richard Duncan, Ed Seykota began developing a futures market trading system in the 1970s. He tested and implemented his ideas on an IBM 360 computer, long before the stock market was traded online. At that time, computers were about the size of a large room and were programmed through punch cards. Initially, he wrote trend trading systems with a number of rules on model identification and risk management. In 1988, one of his client accounts increased by 250,000%. Today, the story is told that his daily work is just a few minutes to run the computer program and look for new trading signals. Ed Seykota's famous saying is quite special. There is an old trader and bold trader, but there are very few investors who are both mature and daring. He also said that experience and blood is one of the most important factors to become a successful investor. Here are 5 tips from the master's experience for public investors who want to succeed, according to an interview on CNN's Financial News. 1. Memorize 4 Ed Seykota survival rules summarized in investment. Included are: 1. Cut loss. 2. Keep interest transactions. 3. Place small bets. 4. Observe rules without doubt, and 5. Know when to break rules. 2. Risk is the unspecified probability of a loss. If you can determine exactly what the risk is, it will no longer be a risk. 3. If you do not accept a small loss, sooner or later investors will have a huge loss. For each purchase order, Seykota always knows the exact cut-loss price if things don't work as planned. He defined this price clearly before trading. Most of him did not focus on the profit aspect but initially focused on the risk aspect. The motto "Think First Risk" means that every investor must understand the risks inherent for each transaction and be prepared to face things that seem impossible. If you want a high return on equity investment, consider the level of risk you are willing to take, and have a predetermined exit plan to protect your account from having too big losses. Otherwise, it will eventually have to return to the market a large part or all of the profits earned. Even, it is still considered lucky if it retains the average rate of return on the account. He is always trying to handle a long chain of losses by reducing trading activity and waiting for new opportunities to be safer. For Seykota, trying to trade while falling into a series of losses is a painful emotion. At the same time, this will make investors pay a lot of money. A better way is to place a small bet and thereby reduce the risk in the period of having the largest account decline, equity drawdown. It is the best way to become more comfortable both emotionally and financially. 4. Transaction of each part of the account. Often we do not know exactly where the bottom is, or exactly where the peak is, so when the market approaches the resistance, it is possible to trade each part of the account to ensure the account is safe and profitable. Investors with trading experience in the market, they will decide to sell 1/3 of the account when the market enters the resistance, 1/3 will continue to sell according to technical indicators, and 1. The remaining 3 will be sold out when the market adjusts to 8% of the peak created. In case the market continues to rise and surpass the resistance, 2/3 of the remaining shares will continue to be maintained, 1/3 of the cash sold will be used to invest in tea and surfing with stocks. There is also an opportunity to increase the market. And the wrong risk has occurred. The loss caused by 1/3 of the account does not affect much to the profit that investors have achieved before. 5. Learn how to read graphs and identify good prices and select appropriate buying points. Use daily and weekly charts to improve stock selection and market timing. Buy any stocks that create breakout points. Break first to exit the good prices with a volume 50% or more higher than the normal trading volume.